How do sovereign borrowers get in trouble? What are the warning signs of sovereign distress? And how does a sovereign debt restructuring happen? Looking back at the history of economic instability, and particularly at the recent euro area debt crisis and the case of Greece in 2012, we discussed these questions with Jeromin Zettelmeyer, Senior Fellow at the Peterson Institute for International Economics. This podcast was recorded at the European University Institute in Florence during an executive training course on sovereign debt risks organized by the Florence School of Banking and Finance.
Dr. Zettelmeyer, thank you very much for your time in responding to our questions and for being with us in Florence in the occasion of this course on sovereign debt risks. Looking back at the history of sovereign debt crisis, what are, in your opinion, the typical ingredients of a crisis?
So, first of all, it's important to define what a crisis is, and there have been various ways of doing that. I usually would define a sovereign debt crisis as an episode where the sovereign loses access to capital markets, and so the ingredients that get you there typically are twofold. They include two elements. One is there is some sort of underlying debt problem that has usually accumulated over time. And by debt problem, I don't just mean the quantity of debt relative to the repayment capacity of the sovereign, but also the structure of the debt. So, quantity might refer to most obviously the level of public debt, but also implicit liabilities, for example, because of private debts in the banking system that require some sort of government rescue. And then the structure of debt can mean a high share of foreign currency debt, which will then become much more onerous to service if there is a devaluation of the currency. Or it could mean a high reliance on short-term debt, which means that the amount of debt that has to be rolled over at any given time is very high. So these are the vulnerabilities. And then, typically you have a trigger of some kind. So, crises may not occur for a long time, even though there are these vulnerabilities, as long as markets are willing to roll over. But at some point they may lose confidence, and that is typically either because of an external shock, like, for example, a fall in commodity prices. If this is a commodity exporter, it could be a rise in world interest rates, or it could be a domestic shock, like a recession that weakens repayment capacity, or a shock to the political system, something like that.
Now, let's assume that those factors that you just mentioned actually happen to be in place, so we are in front of a sovereign debt crisis. How do you diagnose in that occasion whether resolving this crisis requires a debt restructuring or not?
So the key question is whether the sovereign would be able to restore its capacity to pay based on some combination of financing at normal interest rates, so not at crisis rates, and adjustment policies, reform policies that can be implemented within a reasonably short time period. So when these conditions are satisfied, we would probably call this sovereign conditionally solvent. So it may need financing from an official lender like the IMF over a period. It may even need conditionality to make sure that reforms are undertaken, but it will not require debt restructuring. When these conditions are not met, it will require a debt restructuring. And so the tool to decide in which world we are typically involves a so-called debt sustainability analysis. And that's, in its simplest form, is just a projection of the debt ratio, the ratio between the debt burden and GDP going forward. And so if that ratio declines slowly over time or quickly over time, based on realistic assumptions about growth, about the fiscal path, meaning the difference between non-interest expenditures and taxes, and about public borrowing rates. If that is the case, then we would conclude that debt is sustainable. If that's not the case, then a restructuring will generally be required.
But sometimes policymakers try to avoid restructurings or defaults, even when it's clear that the debt is unsustainable. Could you explain why this happens?
Yeah, so I mean, there are two reasons, really. One is that it is very rarely completely clear whether the sovereign debt is unsustainable. And so in instances where it's not completely clear, if you think that the costs of debt restructuring are not rising in time, so they are this like one-time fee or some one-time cost that needs to be incurred regardless of whether you restructure now or later, it may in fact make sense to delay a restructuring to find out whether debt is indeed unsustainable or not. However, often it is the case that the costs of delaying a debt restructuring actually do rise with time, and then it would be optimal from a welfare point of view to restructure early. Still, you sometimes, or quite often find policymakers delaying the restructuring. In cases like that, I think that must necessarily have to do with the fact that their own costs and benefits of delaying are not identical to those of the people that they are representing. And so in particular, it might be the case that restructuring is actually more painful for the elites, for the policymakers, than for the average citizen, perhaps because policymakers stand to lose their jobs or because they're connected to the creditors in some way. And indeed, it may be that the costs of the alternative to a debt restructuring, which is, very intense fiscal adjustment, and so protracted austerity, that they are bigger for the average taxpayer than for the policymaker, because the policymaker is typically shielded from the most direct impact of austerity. And so for this reason, there may be a bias against debt restructuring.
And focusing back on the euro area debt crisis of 2010-2015, what were the peculiarities of this experience compared with the previous sovereign debt crisis in history? And what consequences does this crisis have on the current EU policies in the economic and monetary union?
So I think it's important to stress that there were actually more similarities than differences between the euro area debt crisis and particularly classic emerging market crises. So the common feature of many, if not most, emerging market crises is that they were a result of capital inflows in response to an optimistic view about what was going on in the emerging market, or sometimes in response to low interest rates at the center of the financial system, so a search for yield. And this is pretty much what happened during the euro crisis, that is, in the run-up to the euro crisis. So you have, good news in the periphery of the euro area, which has to do with the creation of the euro, the fact that the investment in these countries would no longer be subject to exchange rate volatility, that they would have the benefit of low inflation through the European Central Bank, and maybe even that their fiscal policies would improve because of the fact that they no longer had access to inflationary financing, and maybe because of the fiscal rules. And all of this adds up to good news, but then markets overreact. The capital inflows into those countries are not necessarily well spent. They don't always go into investment. When they go into investment, they may end up in the housing sector, which is prone to bubbles. And so you get this deterioration of credit quality. You get non-tradable prices of services going up. And so these countries gradually lose competitiveness. So this type of mechanism is very typical, and that was the essential feature of the euro crisis as well. I think that the differences have to do more with the resolution of the crisis. So unlike most emerging market crises, devaluation was not an option in the euro crisis. as a way of restoring competitiveness. At the same time, you had some advantages that you did not have, say, in crises that involve pegged exchange rates, but not inside a currency union. So you can think of a currency union as being equivalent to a pegged exchange rate regime, a hard peg, like a currency board, but with one big difference, which is you can, arbitrarily borrow from the country that you're pegging to in order to finance capital outflows. And so that puts, in principle, the crisis country into a stronger position of resisting the impact of the crisis than a standard emerging market. There is one important caveat, however. Just like with an emerging market that borrows in foreign currency, countries inside a currency union do not, or at least did not, automatically have access to a central bank that would provide liquidity to the government debt market when there's a run on the government debt market. So while the monetary union has this nice features of automatically financing capital outflows, it does not automatically provide a backstop to the government itself. There is no government lender of last resort. And this was one of the reasons why the crisis expanded to countries like Spain and Italy in 2011. And it took essentially innovation on the side of euro area policymakers to recognize this problem and put a stop to it. So to get to the last part of your question, the crisis did trigger innovations in a number of areas, some of them having to do with crisis prevention. So the importance of capital flows and financial supervision and generally credit bubbles as a cause of crisis in the euro area was underestimated, and this was gradually repaired through the reforms that we now collectively refer to as banking unions. So a single supervisory mechanism, a single resolution mechanism, a fund that's supposed to finance resolution. And at the same time, we now have some instruments, particularly the ESM, the European Stability Mechanism, and the policy of the ECB that's known as OMT, outright monetary transactions, that in a sense substitute for the lack of a central bank that backstops the government. And it does so in a way that preserves the mandate of the ECB and does not conflict with the prohibition of monetary financing by requiring that governments that benefit from the backstop undergo an ESM financed adjustment program. So the conditionality is supposed to ensure that ECB money can eventually be repaid, that the ECB does not actually lose money in intervening in government bond markets.
And looking at the specific case of Greece, in 2012 its debt restructuring achieved a very large debt relief with seemingly little financial disruption. What were its success factors? And on the other side of the coin, what were the costs of such an operation?
So the main success factor was the so-called local law advantage. So the Greek crisis was complicated by the fact that when the euro area authorities finally decided that a restructuring was needed, they at the same time prescribed complete voluntariness to the restructuring. And so one important mechanism that helps when it comes to maximizing participation in a debt exchange, namely that the authorities leave some ambiguity on how holdouts, that is, non-participating creditors, will be treated. This ambiguity was removed by emphasizing that the exchange was literally voluntary, that holdouts would be repaid. So this implicit stick that has been a very important success factor for past debt restructurings was missing. And so the challenge of the designers of the debt restructuring, which included Lee Buchheit, with whom I just co-taught a course, consisted in making a very deep restructuring happening in a situation in which the sovereign was really hobbled in terms of how to create incentives for participation. And the answer that he and Mitu Gulati, who is also part of our team, suggested in an article several years before the restructuring in May 2010 was to exploit the fact that most Greek debt was issued under local law. And that basically allowed the legislature, the Greek parliament, to change the terms under which this debt had been issued retroactively. Now, when doing a thing like that, it is very important not to bump up against legal constraints that come from general constitutional principles. So you cannot abuse this enormous power by expropriating creditors. And so the genius of what Buchheit and Gulati suggested was to use this huge power not to prescribe new payment terms, but merely to prescribe a procedure with which the debt could be changed, could be restructured, with a supermajority of the votes of creditors across all bonds. And so that both preserved the legitimacy of the restructuring. So in the end, it was 83% of the holders of domestic law that voted in favor of the restructuring, well above the threshold that would have been needed under the voting mechanism that was legislated. But it made it almost impossible for holdout creditors to acquire a blocking position that would have impeded the restructuring. And so this was the essential reason why the restructuring worked. Now, I think you also mentioned bad precedents.
Mm-hmm.
So there are mainly two. So one is that indeed holdouts were repaid in full, meaning that, to the extent that there was still any ambiguity ex ante, it was removed. And so it is hard to see that how, holdout problems, or let's put it this way, it's going to be harder to contain holdout problems in future euro area restructurings because there will be a strong presumption that anyone holding out will in fact be repaid in full. So it will be more difficult to get to whatever threshold is enacted to bind the holdout creditors to a restructuring accepted by the majority. So even if the local law advantage is exploited again in the future, and some argue that it could be exploited in other cases that have predominantly local law debt, it's going to be more difficult to actually jump over the threshold. So I think that is the main bad precedent. Another not so favorable or at least replicable fact of the Greek restructuring is that in the end it was quite costly from an official financing perspective. So not only was the Greek program itself very costly in that huge amounts were lent to Greece, but the restructuring itself required about 30 billion in financial incentives. Basically cash incentives that would be paid out immediately to creditors, plus, about the same order of magnitude in additional loans to compensate the banks for the loss of capital, the Greek banks for the loss of capital by having their bonds written down. And so it is kind of difficult to see that we will get that kind of level of generosity in terms of official support in a future restructuring in the euro area, particularly if that restructuring should involve larger amounts of debt outstanding than were outstanding in Greece.
Yeah, and I would like to take particularly your final point on the effects of the Greek precedent and the future debt crisis in Europe. What do you think will be the impact of the precedents as well as the current EU policies for European countries, such as, for example, Italy, and also elsewhere in the world, such as, for example, the case of Venezuela?
So the one lesson from Greece is that a judicially applied local law advantage can go a long way. So that, I think, is a positive precedent, and in an environment where we still do not have collective action clauses that would enable one vote across all bond series, that could be very important. Note that that type of innovation has, in the meantime, been accepted by the Eurogroup, so we will have new types of collective action clauses that do enable the type of voting that was actually done in Greece in future euro area bonds, but only starting from 2022. So until then, we may have to rely on the local law advantage for countries with large stocks of local law outstanding, in the event that the collective action clauses that have been implemented in euro area bonds since 2013 do not work out. So I think that is sort of the main precedent. From the perspective of Venezuela, I'm not sure there are actually a huge lessons to be learned. So, the Venezuelan restructuring is very different from the Greek one. In fact, for many other restructurings, even emerging market restructurings, in that the creditors of Venezuela potentially have many, many more assets to attach than would have been available in the case of Greece, because very large amounts of Venezuelan assets are located outside the country in the United States. And because, Venezuela relies on oil exports, and oil exports are something you can potentially interfere with as a holdout creditor. So this is going to be an even harder restructuring than Greece. There's also no local law advantage. So these are, for the most part, foreign law bonds. And so it will require a completely different approach, probably one that borrows more from extreme cases of restructuring of other oil exporting countries, particularly Iraq, that was restructured after the collapse of the Saddam Hussein regime. And again, my colleagues Lee and me to have recently written about that. So I very much recommend their work on that question.
Now let's close this podcast with a final question, which looks a little bit at the future. How would you design a European sovereign debt restructuring mechanism? And how would this mechanism, in your opinion, how could it be inserted in the current European framework?
So I think a debt restructuring mechanism has to achieve two aims. So one is to deal with the legal problems of debt restructuring, and the main one is how to get collective agreement of creditors to a restructuring that might be collectively in the interests of creditors, but might not be in the individual creditor's interest, because conditional on the majority of creditors deciding to take a deal, meaning accepting debt relief, it is always in the interest of individual creditors to request full repayment, right? Once a debt restructuring has been agreed, the country can actually repay. So this is known as the holdout problem. And as I said, in the Greek case, this was addressed through the use of local law. But this is a trick that you cannot continue indefinitely, and moreover, not all euro area debt is in local law. So that problem needs to be addressed. But from an economic point of view, there's an even bigger problem that needs to be addressed, which is that even if you deal with holdouts, even if you have a legal procedure that is legitimate and gets you to a restructuring in relatively short time, restructurings tend to be very traumatic events for the countries involved and for other countries in the euro area. And for this reason, the temptation to attempt to stave off restructurings, even when they're needed, and to go for other crisis management strategies, even when they're very unlikely to succeed, for example, subjecting a country to extended austerity, that temptation is going to be very big. So if you want a successful restructuring regime, you have to lower the costs of restructuring exposed. And even if you manage to do that, there is it is often the case that it is hard to bite the bullet. So you may have to sort of toughen the conditions of accessing alternatives to debt restructuring, namely ESM-financed crisis lending a bit, and really ensure that the conditions of those loans require debt sustainability. So this is kind of implicit in the current ESM treaty, but it could be made more explicit. So how do you do these three things? So the first one, the holdout problem, you can address by having the so-called single limb collective action clause that I just discussed, and that will happen from 2022 onwards. So that, in principle, should be underway, even though it will take some time. The clarification with respect to conditions under which official borrowing is available also will happen. There was, in fact, little ambiguity about this, but it is worth strengthening that. And so the Eurogroup came up with some language that will make that clear. And I imagine that language will be put into a revised version of the ESM treaty. But then the final element, which is to reduce the costs of debt restructurings exposed, that is a much tougher objective to attain. And so for that, you need sort of a very broad-based euro area architecture reform program that is mainly about putting in safety nets, which are designed in a way that they do not themselves distort incentives. So I'm talking things like a well-designed European deposit insurance, possibly a well-designed fiscal risk-sharing mechanism like some form of unemployment insurance or reinsurance, backstop type thing. I'm talking about somewhat easier access to ESM lending, and finally, and most ambitiously, I'm talking about reducing the exposures of banks to sovereigns, particularly concentrated exposures to their own sovereigns. And that in turn might require that you have to give the banks some kind of alternative along the lines of a European safe asset. So that's a very broad agenda. But for me, it is really part of this objective of making debt restructurals feasible as a last resort to deep crisis in the euro area.
Thank you very much for having shared your thoughts on this and for your time.
Thank you.
Thank you for having listened to this podcast by the Florence School of Banking and Finance. For more information and to listen to all our podcasts, visit the webpage fbf.ui.eu/podcasts.